What's up guys, my name is Nick and welcome to my channel. Today we're going to look at a very popular short premium income generating option strategy, the Iron Condor. It's particularly useful for smaller accounts because of the defined risk nature of the trade. Before we get into the video, do me a huge favor though, smash the like button, subscribe to the channel, it helps me out a ton. Okay, with that said, enjoy the video and I'll see you on the other side. I'm currently inside my tastyworks platform and I've opened up an options chain on Apple stock. The date for the expiration of those options is October the 30th, which is 31 days away from the current time that I'm making this recording. Now, we know that options that expire out of the money will ultimately be worthless. So if we take a look at an option that's out of the money right now, the 105 put, just a side note, we have Apple trading currently at 114.09. So in the event that Apple does stay at this level, and specifically above 105, the 105 put would be worthless. So currently it has extrinsic value of around $2.60. So if we just fast forward now to the October 2nd options chain, we can see what that option might look like with just 3 days to go to expiration. So as you can see, the 105 put now with 3 days to go is worth just 9 or 10 cents. This extrinsic value in the passage of time has depleted the value in the option. So instead of fighting time decay by buying options, let's take a look at a strategy that can put time decay on your side, even with a small account. So, in order to take advantage of the passage of time, or what is known as theta decay, we could look at selling an out-of-the-money call and an out-of-the-money put option. We'd hope that over the course of the trade, up until the expiration date, that while the stock might drift higher or lower, it ultimately remains between these two short strikes. In this case, both options would expire worthless, and as the options seller, we'd pocket the premium for which we sold the options initially. The problem with this trade, which is referred to as a strangle, is that naked options come with theoretically unlimited risk and as a result have a high capital requirement. In order to reduce this risk and set up a trade that would work in a smaller account, we can also purchase an out-of-the-money call and an out-of-the-money put. This allows the trader to benefit from the passage of time and the theta decay, but also limit the risk associated with the position. Altogether, the individual legs of this trade are collectively referred to as an Iron Condor. Let's take a look at a specific example. This is an options chain for ABC stock. Let's assume, like the Apple chain that we looked at earlier in the introduction, that these options have approximately 30 days to go to expiration. ABC stock is currently trading at $100 a share. We can sell the 105 call and the 95 put for $2 each, and receive a net credit of $4 with the hope that the stock remains between these two strikes by expiration. This trade though has theoretically unlimited risk since the options are naked. Let's buy the 110 call then for $1 and on the downside the 90 put. Now we have defined our risk. Let's take a look at two potential outcomes depending on the stock's performance prior to the expiration date. In our first example, let's suppose that the stock trades a little higher, a little lower, but ultimately never breaches either short strike and remains between 95 and 105 by the expiration date. Again, recall our Iron Condor is constructed by simultaneously selling the 105 call and 95 put, but also buying the 110 call and the 90 put. Despite the fact that this trade has 4 individual option legs, most brokerages will allow you to enter the position as a single transaction. Okay, so at expiration, we see that all the options are out of the money. Both call strikes are higher than the current stock price and both put strikes are lower than the current stock price. So all options expire worthless. But how does this affect our overall Iron Condor position profit or loss? Well, the two options we sold, we pocket a nice credit. Since we sold each option for $2 each, we collect $200 in premium from the sale of both the 105 call and the 95 put for a total of $400 in profit. But we also lose money on the options that we bought. Since the premium we spent on each option is $1, we lose $100 on the purchase of the 110 call and $100 on the 90 put. We can sum these all together and see that our net profit is $200, a very nice 1 month return on capital. Don't think of the loss on the bought long options as a bad thing. We purchased these options as protection and fortunately in this case we didn't need them. Think of it as insurance. You have to have insurance for your car, but you don't hope to be in an accident, so you get to cash in, right? And the long options are there for the same reason, to protect you against a worst case scenario. Talking of which, let's take a look at an example that doesn't work out so well. How much can we possibly lose on the trade? Let's say the stock rallies and moves outside of the range we want it to stay in and ends up at $112 per share. Again, both the long put and short put strikes are below the current stock price, so both of these options are worthless at expiration. We make $200 from selling the 95 strike, but we lose $100 on the purchase of the 90 put. The calls, on the other hand, are both in the money. So how much is each worth? Well, the 110 call is $2 in the money, and so is worth $2. Since we bought the option for $1, the profit from the position is the difference, or $1 or $100 per contract. The 105 call we sold is $7 in the money. Since we sold this for $2, the difference or net loss on the position is $500. The net loss then from each of the 4 individual legs is $300. Here's an important point though. The strategy makes the maximum loss when the stop price closes outside of either the long call or put option strike. This is the maximum the position can ever lose, regardless of whether the stock goes to 120, 150 or 0, it doesn't matter. The maximum loss is capped regardless of how far the stock moves and is calculated by taking the difference between the long and short strikes, in this example for the call side, the difference between 110 and 105, or alternatively on the put side, the difference between 95 and 90, or $5, and the net credit that the spread was initially sold for, in this case $2. The maximum loss then is $3 or $300 per contract. Let's look at the payoff profile at expiration. On the x-axis we can see the price of the stock. This increases as we move from the left to the right. On the y-axis we have the profit or loss on the position. Note below the x-axis the trade loses money, and above the x-axis the trade makes a profit. But how much, and where are the break-evens? Well, the maximum profit is the price that we sell the iron Condor for, or the net credit that we receive to open the position. In this trade, that's $2 or $200 per contract. The maximum loss occurs when the stock closes outside either of the long options at expiration. That loss is equal to the difference between the long and short strikes less the net credit received for opening the position. In this example, that's $3 or $300 per contract, which is also the capital requirement to place the trade with your broker. This trade has 2 different break-evens, and these levels are found by taking the short call strike and adding in that premium, so that's 105 plus $2 or $107, and taking the short put strike and subtracting the net premium, so 95 minus $2 or $93 per share. You may be wondering about the risk reward of the trade. Why risk $300 to only make 2? Well, that's only part of the story. It's important to understand the probability that the trade is profitable. The higher the probability a trade is profitable, so the lower the reward relative to the associated risk. The lower the probability of profit, so the higher the potential reward. Let's take a look at setting up a trade. So here we are back in the tastyworks platform. Again, we're looking at the same options chain we looked at earlier. Apple stock, the expiry of the options is October the 30th, which is about 30 days to expiration. Okay, this is a nice little sweet spot around that 30 to 40 days expiration. You're just starting to see the theta start to accelerate as we come into expiration, but you've also still got some decent levels of premium in that sort of time to expiration. So let's look to set up an iron Condor then. So first of all, let's look for the short strikes. So we're trading somewhere between 114 and 115. So if I take a look at something like the 130 strike, has a 14% probability of being in the money at expiration. That's the sort of levels we want to be kind of looking at. And then on the downside, the similar sort of distance. Let's go for the 100 strike there, which will put them fairly much either side of where the current stock price is. Let's lock in some wings and a bad downside put and buy the $5 lower put, and that'll be the 95 strike, and the calls on the upside at 135. Okay, so the first thing to note is we can look at the various analytics for this position. The probability of profit is almost 70%, it's around 68%. This is a reflection of the fact that the short strikes are actually quite far away from the money strikes. If we want to change that probability of profit, we move the short strikes closer to the current at the money. The net result of that is that the premium that you receive from selling the strategy increases and becomes a larger proportion of the width of the strikes. So currently, our maximum loss is $384, which is the difference between the $5 wide strikes, so that's 130 or 135, or you could look at it on the put side, 195. Or incidentally, if you do what's called a broken wing butterfly, when your put and call strikes have different widths, you would take the larger of the two to work out what your maximum possible risk is. Right, so the current credit that you receive is 116. Which is okay. I mean, it's not too bad. If you do prefer a different risk reward though, as I say, I want to just slip the strikes a little bit closer on this side. That's 5 closer here. So slip these 5 closer as well on the put side. And there we go. So you can see that the probability of profit falls to around 54%, but now we're getting a more substantial fraction of the overall width of the spreads. Okay. Guys, if you made it this far, you made it to the end, and your support is very, very much appreciated. Again, do me a huge favor. Smash the like button, subscribe to the channel. It helps me out a ton. I'll see you on the next one. Cheers.